Good morning, good afternoon, good evening, since we have people gathering from all over the world. Thank you for joining us today. My name is Ann Florini, and on behalf of the Thunderbird School of Global Management at Arizona State University, I'd like to welcome you to the latest in our series on finance and sustainability. We are grateful to have the GW Institute of International Economic Policy as our co-host today. And in just a few minutes, I'm going to turn the proceedings over to James Foster, the director of that institute. But let me start by giving a little bit of background on why Thunderbird is doing a series on finance and sustainability. We've known for some time, for several years, that we're really facing a series of interlocking crises in the world, which often get grouped under the heading of sustainability. Environmental, social, governance kinds of crises that have left us with a very fragile world. To deal with those kind of systemic challenges, it makes sense to look for what are the levers of change? How is it that you can change whole systems rather than just making incremental changes? And clearly, one of the areas that it makes a great deal of sense to look at is finance. Solution to many problems is start by following the money. Even before the pandemic, we saw some very major trends going on in the financial sector, both the public sector and the private sector. As most people on this webinar will have heard, there's been a huge push in the last several years for more attention in what's called ESG investing, environmental, social, governance focused investing that takes into account things other than short-term financial returns. To give you just one example of how far that conversation has gone, and we've certainly seen that ESG investing has held up quite robustly during the pandemic, I've been in conversations lately with people in places like private equity firms who are trying to figure out not just how do you set up a side fund with some green bonds in it, but how do you fundamentally change your business model so that all of the funds that you are managing, all of the companies that you're investing in, are aimed toward broader, longer-term sustainability on all fronts. That's a very big change in the conversation from the kinds of conversations that we were having in finance several years ago. And on the public side, you're going to hear at some length today about the role of central banks and financial regulators and how we're governing finance from that perspective. But there's a lot of other ways in which the public sector is weighing in on this question of how do we manage these interlocking crises and what is the role of the financial sector. For example, I have been part of conversations with an Asian sovereign wealth fund that several years ago adopted the Sustainable Development Goals, the UN's goals, as a framework, and has since been encouraging the companies in which it invests very strongly to take seriously the SDGs as a framework for their own operations. So when I had the opportunity a few years ago to join Thunderbird and, among other things, help to create a new kind of master's program for mid-career professionals, one of the areas that it seemed clearly needed some rethinking was how do we teach about finance? So in addition to the kind of corporate finance course that every management school needs to offer, we also wanted to introduce people in their 30s, 40s, 50s from the public and private sectors to a deeper understanding of finance as a sector, finance as a system, and how it is shifting and why it is facing the kinds of pressures that it is. I had the great pleasure of teaching that course for the first time several months ago. And a few of the mid-career students who were part of that program then, I think, are joining the webinar today. And as part of that, I had the great good fortune of convincing Alex Barkawi to come in as a guest lecturer and help to explain what was happening with the governance of finance around the world. So we're delighted to see him again today. But as we put that all together and as we offered that course, it became very obvious that there was a real need to help people in both the public and private sectors have a much deeper understanding and a way of keeping track of what is going on in this very rapidly developing field. How is it that we understand not only where we are, but where we might be going? And how do we have a reasoned conversation about what should happen to global finance? Hence this webinar series, appealing to a broader audience, and also a broader initiative on finance and sustainability that we're in the process of developing. So a lot of background for why we're having this specific webinar. We have also been very fortunate, as I said, to have IIEP as a partner in several of these webinars. And with that, let me turn it over to James Foster.
Thank you so much, Ann. It's a real pleasure for the Institute for International Economic Policy, or IIEP as we call it, to be co-sponsoring this series with Thunderbird and ASU. This is a partnership that traces back to June of last year in the early days of the pandemic. First, a few words about IIEP and the Elliott School of International Affairs at the George Washington University. As the largest school of international affairs, the top-ranked Elliott School has a remarkable location, a quick stroll from the World Bank, the Treasury, the Fed, and the Fund. The latest news from our part of Foggy Bottom is that there's a new dean at the Elliott School, Dr. Alyssa Ayers, an expert in South Asia who I believe will take our school to the next level. I also want to welcome back Jay Shambaugh, who recently returned from Brookings, who is joining me as co-director of IIEP. He's here today. Now, IIEP is a research institute within the Elliott School, where scholars and policymakers discuss their newest findings on such topics as global governance, climate change, and multidimensional poverty. Last week, our Facing Inequality series brought Betsy Stevenson, who showed how the pandemic has lifted the curtain on existing gender inequalities. On Friday, the 26th, our Envisioning India series will bring together former World Bank chief economists Kaushik Basu, Mahendra Dev, and Sudha Narayanan for a discussion of India's farm laws. And on Friday, March 6th, our China conference features Meg Rithmeyer of Harvard Business School, who will present China's outward investments, state capitalism or capital flight. If you miss an IIEP event, you can check out our YouTube channel at IIEP-GW. I'm now happy to introduce Sunil Sharma, distinguished scholar in IIEP, who will moderate today's special event. Sunil and I go way back to a small village in upstate New York, where we both were trained by a group of hardy Cornell economists. After teaching at UCLA, Sunil joined the IMF and had an illustrious 25-year career with the fund, writing, training, and helping countries. We are deeply thankful to Sunil and Ann for organizing this series. Sunil, the floor is yours.
Thank you very much, James. So today we have the fourth seminar in the series on rethinking capitalism and democracy. Let me say a few words about the seminar series. In the first seminar, Valuing Nature, Whales, Elephants, and the Global Economy, Ralph Chammy and Conal Fullenkamp presented a novel science-based valuation framework for pricing nature's services. They then went on to argue that we should be thinking about the preservation and valuation, not just of individual keystone species, but the entire ecosystems they inhabit. What they said is highly relevant to the recent Dasgupta report on the economics of biodiversity. In the second seminar, Sustainability and the Architecture of Global Finance, Simon Zadek looked at the broader environmental sustainability agenda and the ways in which the architecture of global finance is changing under growing pressures to take environmental and social issues seriously in financial decision-making, as Anne has just outlined. In the third seminar, Taking Stock of Climate Change, Earth, Air, Fire, and Water, we had Sir David Henry and Dr. Jennifer Castle show how humanity is altering climate with impacts on the Earth's limited available land, atmosphere, and water resources. They used the ancient frames of earth, air, fire, and water to explore what is happening, the dangers of precipitating an anthropogenic mass extinction, and actions humanity could take to avoid disaster. We started this series on rethinking capitalism and democracy during the current COVID-19 pandemic, which, like the global financial crisis a decade ago, has again laid bare the cracks in the leading capitalist democracies and other countries. The world is in a particularly delicate state. In a little more than a decade, we've had two systemic crises. governments, private corporations, and households are burdened by more debt than the world has ever seen in peacetime. Political polarization in major capitalist democracies has made it difficult for societies to be deliberative and make hard choices. And as the global financial crisis and the pandemic have shown, the consequences of inaction will be borne disproportionately by the less fortunate in society, and the political fallout could make it even harder to face up to future systemic challenges that will undoubtedly arise. The critical questions we confront cut across discipline, and the issues of governance and design of institutions will be an important part of proposed solutions. Today's seminar focuses on governing finance for sustainability. Finance affects all aspects of our lives, from our economies to social cohesion to the ecological systems that we depend on for our survival. As a result, the implications of how we govern finance are truly fundamental. In the last few years, central banks and financial supervisors have been reassessing the economic and social landscape they face, as well as their broader role in achieving sustainable prosperity. Today's seminar examines the opportunities and challenges for financial governance, explores emerging new practices among central banks and financial supervisors, and outlines ways for having greater alignment of financial governance with the broader sustainability agenda. There are two major issues we currently are grappling with: inequality and climate change. The question that naturally arises is how the governance and operation of our financial systems can contribute to make societies fairer and just, and help humanity make peace with nature. Even before the 2008 crisis, questions were being raised about the efficacy of monetary and financial policies and the governance of the financial system. After the 2008 crisis, with monetary and financial policies playing a much larger role, and the distributional consequences of the novel monetary and financial interventions being hard to ignore, governance and oversight of the monetary and financial system is a legitimate question for a broader public discussion. And by that I mean is that traditionally this has been discussed among the central bank community, but I think now is a time for a much broader question. So with that, let me introduce today's speakers. Alex Barkawi is founder and director of the Council on Economic Policies, an economic policy think tank for sustainability focused on fiscal, monetary, and trade policy. Prior to creating and building CEP, he was the managing director of SAM Indexes, and thus responsible for developing the Dow Jones Sustainability Indices into a key reference point for sustainable investment. Alex is a graduate in economics of the University of St. Gallen in Switzerland, where he also earned his doctoral degree. He grew up in Germany and Egypt, and today lives in Zurich, Switzerland. We'll also have, after Alex's presentation, some comments from my colleague, Professor Jay Shambaugh. His area of research is macroeconomics and international economics. He has had 2 stints in public service. He served as a member of the White House Council of Economic Advisors from 2015 to 2017. Earlier, he had served on the staff of the Council of Economic Advisors as a senior economist for international economics, and then as the chief economist. He also spent 3 years as the director of the Hamilton Project at the Brookings Institution. Jay is also a faculty research fellow at the NBER and non-resident senior fellow in economic studies at Brookings. Prior to joining us at George Washington University, Jay taught at Georgetown and Dartmouth and was a visiting scholar at the IMF. He has a doctorate from Berkeley, a master's from the Fletcher School at Tufts, and a BA from Yale University. With that, let me hand it over to Alex.
Thank you so much, Sunil. Thank you, Ann. Thank you, James, for the warm welcome. It's a tremendous pleasure to be here. And I'd like to start off by thanking all of you who are online with us here for joining the conversation. Obviously, also particular thanking you, Jay, for joining us. Because I believe, as Sunil alluded to, that having a broader conversation about the governance of finance is both important as well as urgent. And I'm very grateful to be able to share a few thoughts with you and then, more importantly, discuss and jointly take that debate forward. So the governance of finance, which I would loosely define as the rules and policies and the mechanisms that provide the guardrails for financial markets, is a central pillar of our economies and societies. And as Sunil said, whether we succeed in improving lives, in creating opportunity, in strengthening communities, and in also protecting nature depends greatly on financial markets and thus ultimately on how we choose to govern them. And yet, interestingly, surprisingly, alarmingly, for a very long time, we did not have these type of conversations on the governance of finance and on the links between the institutions governing finance and the broader topic of sustainability and sustainable prosperity. And instead, we progressively narrowed down the conversation to the view that everything that central banks can and should do is about price stability, financial stability, and in some countries actually narrowing it down to a purely price stability focused conversation. And I think that got us onto a wrong track, at least the wrong track for the challenges that we're facing today. I also happen to believe that this narrative about a narrow mandate of the institutions governing finance does not match up with reality. Because if you look closely, the institutions governing finance do so much more than this narrow narrative around price stability would lead us to believe. If you take the Federal Reserve, they would list at least five key functions: conducting monetary policy, taking care of microprudential supervision of individual financial institutions, taking care of macroprudential policy to ensure the financial stability of the entire system, having a role in payment and settlement systems, and finally also playing a crucial role in both consumer protection as well as community development. And then Sunil was referring to that as well, came COVID-19. And I think with that, yet another glaring spotlight on this absolutely critical role that the institutions governing finance play. Because whether governments had access to funding to increase healthcare capacity, whether corporations were able to secure liquidity to secure jobs and come back after lockdowns, or whether we had the payment systems in place so that emergency cash could actually reach the households in need. At the core of all that stood not only, but also central bank and financial supervisors playing their role. And recognizing this broader role these institutions have in both normal times and during crises, I believe is essential. And I hope that the conversation we're having today can contribute to a broader debate that will help increase momentum. And Anne has already alluded to the fact that we're seeing emerging practice in that direction, to increase momentum to ensure that the governance of finance, its purpose, its instruments, and its institutions get better aligned, more aligned with what I think the ultimate goal must be, and that is sustainable prosperity. So let me start with what I would see as the first building block here, the purpose of the governance of finance. The purpose of the governance of finance has never been set in stone. The mandates of central banks and financial supervisors have kept evolving over time. After World War II, the central banks played a key role in the development of countries. You had several central banks worldwide that were intricately involved in channeling capital flows to priority sector and to targeted infrastructure. And then in the leading up to the 1990s, as inflation went up, we had this consensus that is still around today, emerging that no, this is not the role of central banks. Central banks should be focused very narrowly on price stability. And in order for them to do that, they need a certain degree of autonomy from politicians and policymaking. And then came 2008. And we realized that a narrow focus on price stability doesn't safeguard us against a crisis. We suddenly realized that financial stability is equally important. And we saw central banks come in with greatly expanding their toolbox, the instruments they were deploying, and moving financial stability up their agendas. And since then, I would argue policymakers have increasingly recognized that even that is not enough, that even if we keep an eye on price stability and financial stability, these are not sufficient prerequisites to safeguard sustainable prosperity. In spite of, we can have price stability and financial stability, but we would still have high unemployment, stagnating wages, increasing inequality that endangers social cohesion, environmental threats, which are not captured by a narrow view on price stability and financial stability. And while I'm far from arguing that those governing finance can solve all that, I argue that they must play a role. And I would quote the G20, which has repeatedly said that in addressing all these questions that Ann also alluded to earlier, all hands need to be on deck. And we simply cannot carve out financial governance from that imperative. Such a broader purpose for central banks and financial authorities and other agencies involved in the governance of finance does not preclude us from setting priorities. Price stability and financial stability will always rank high, I think, on the agendas of central banks. It also doesn't preclude us from setting primary goals and secondary goals. But the broader purpose of sustainable prosperity, I would argue, must be firmly embedded in the mandates and the practice of the institutions governing finance. And now, interestingly, and I would think crucially, central bank mandates are, in most cases, already much broader than this prevailing narrative around a narrow set of objectives would lead us to believe. Take again the Federal Reserve. Its monetary policy mandate covers 3 objectives: employment, price stability, and moderate interest rates. The Bank of Canada has the objective of, and I quote, to promote the economic and financial welfare of Canada. And interestingly, the European Central Bank, which is often seen as this poster child of a central bank, which is completely independent and has a narrow mandate, the ECB, yes, has price stability anchored in its mandate as its primary objective, but then the mandate of the ECB goes on and says, without prejudice to the objective of price stability, the ECB shall support the economic policies in the European Union with a view to achieving the goals of the Union. And in the original text, it says, as defined in Article 3. And if you then look into Article 3 of the European Treaty, you would find a whole range of sustainability objectives referenced in there, including full employment and a high quality of the environment. It's in there. Which brings me to the very important topic of the interpretation of mandates. Because while legislation already very often defines the objectives, the purpose of the institutions governing finance in a much broader way, in our interpretations over the last 2-3 decades, we have narrowed it down. And here, I would like to again use the ECB as a case in point for 2 things. On the one hand, how parts of its mandate got ignored for a long time, but also, again, linking back to what Ann said, how this is shifting now. And let me just, by sharing my screen, share 2 quotes with you here. Just need to go up here. Here we go. The first one from Mario Draghi, then the president of the European Central Bank, who in 2015 said, the mandate entrusted to the ECB is to safeguard price stability in the euro area. That's where his sentence stopped. The second mandate was not mentioned, and this is not the only example that is out there. And the more recent illustration coming from Frank Alderson, who joined the executive board of the European Central Bank recently, and an article wrote that actually two crucial things. On the one hand, that the second part of the ECB mandate, he says sometimes, I would say frequently, got overlooked. And that this second part of its mandate is a duty, not an option. Jens Weidmann, the president of the German central bank, the Bundesbank, said in a recent speech, and again, I'd like to quote him, "It is not up to independent central banks to correct or replace political decisions." And he was saying that, arguing against a larger role of central banks in addressing climate change. And I think he's right when he says that central banks should not correct political decisions. But I think it is equally true that central banks should not be choosing to follow parts of their mandate and to disregard other parts. And that very much applies to the ECB. Which leads me to the second core building block to align financial governance with sustainable prosperity: the instruments that central banks and financial supervisors deploy to fulfill their tasks. Financial governance rests on a vast and actually growing toolbox. The instruments at the disposal of those governing finance range from moving policy rates, interest rates up or down, asset purchases, targeting refinancing lines, setting capital requirements, doing stress tests across the sector. They also include security regulations, as well as the development and maintenance of key parts of financial market infrastructure. I mentioned the role that the Fed plays earlier with regard to payment and settlement systems. And ensuring the coherence of these instruments with that broader notion, this broader goal of sustainable prosperity, I think is at the core of what those responsible need to do, and assessing the trade-offs in between the different goals that I think should be on their agenda as they deploy these instruments must be a core part of that. And I'd like to just give you a few examples of these type of trade-offs that I'm thinking about, and thereby also illustrate that dealing with trade-offs is already very much part of institutions governing finance. And I'm mentioning it because very often when we talk about the need for a central bank, for example, to look at climate change or to look at inequality, one of the responses we get is, well, no, that you're getting them into a trade-off and you can't let them deal with trade-offs. They're not meant to do that. And I think that just doesn't match up with reality, because they're already dealing with trade-offs. They're already pursuing goals with regard to price stability and financial stability. They're already in their role as financial supervisors, safeguarding financial markets by being stricter on banks, but at the same time seeking to drive innovation and competitiveness, which might lead them to be less strict on certain areas. And just to give you a few more examples on where these trade-offs are, just a few here. So central bank lending and asset purchases may be effective in reducing deflationary tendencies in meeting price stability goals, but as I was alluding to, but may come at the expense of financial stability. And moreover, central banks engaging in asset purchases to pursue their price stability goal may actually be exacerbating wealth inequality. Depending on the assets that they purchase, central banks may actually also furthermore create environmental risks on their own balance sheet and to the economy as the whole. And finally, stricter compliance measures for banks may mitigate against bank failures or financial crimes, but as I said earlier, may make it more difficult for smaller banks to compete and thereby counter the objective to raise competitiveness in the financial sector and to move against concentration tendencies in finance. And accounting for these different effects and aligning the toolbox with this broader set of objectives, I think is crucial as we explore a potential evolution of the governance of finance. Let me zoom in on one particular area where these broader sustainability objectives have already made an inroad into the governance of finance, and that is the increased engagement among central banks on the topic of climate change. 10 years ago, the notion that central banks and financial supervisors can and should play a role in addressing climate change would have, and I know because it happened to me, would have created blank stares and a lot of questions of what one thing has to do with the other. And today we have just to give you one example, central banks and supervisors network for greening the financial system with 100 members worldwide, central banks, supervisors, including, by the way, since last December, the Federal Reserve, that has the aim, and I quote again, to share best practices and contribute to the development of environment and climate risk management in the financial sector, and to mobilize mainstream finance to support the transition toward a sustainable economy. And I wanted to share this objective with you in full because I think it illustrates in a perfect way the two different narratives under which the engagement of central banks and supervisors is being driven forward on climate change. Most of the engagement so far among central banks and financial supervisors is being driven ahead under what many, including me, refer to as a risk narrative, where the argument is that climate change poses financial risks, and because of these financial risks, it is in the remit, within the mandate of central banks and supervisors to address that issue. And for example, to make sure that their own balance sheets as central banks are protected against such financial risks, and that the financial institutions which they supervise, as well as the system as a whole, is protected against climate risks. Some of the engagement is already going a step further, pointing to the need for policy coherence and arguing that it doesn't actually make sense to limit ourselves to deal with a challenge that is as big and as, I think, Sunil, you mentioned the word existential, as climate change, to deal with such a threat solely through the lens of what it does to price stability and financial stability, but to rather say this is a goal that we need to address in and of itself. And being clear about these two different narratives, the risk narrative and the policy coherence narrative, is, I think, immensely important also to understand the different positions that people take on it. And some of you may have listened to or read about yesterday's hearing in the US Senate with Federal Reserve Chairman Jay Powell, in which Senator Brown opened, amongst other things, with the following statement saying, the Fed can require that financial institutions take into account the serious risk posed by the climate crisis. And where subsequently Senator Toomey said, and I quote again, as noble as the aim might seem, addressing issues such as climate change or racial inequality are simply not in the purview of the Federal Reserve. And for me, I think, again, this is a perfect illustration of the different narratives, because as I understand it, Senator Brown is referring to the risk narrative, and Senator Toomey argues against the broadening of central bank objectives that would result from further pushing towards policy coherence. I'm bringing this up here because I think it is important for us to keep that in mind, because very often what we see worldwide in this conversation is that people talk past each other. Some talk about a risk approach and some talk about a policy coherence approach. And we need to acknowledge that the momentum on the risk approach is much more advanced than what we see on the policy coherence side. And I'll talk a little bit about that in a second. So within the risk frame, central banks are exploring how to better account for climate-related financial risks within their own monetary policy operations, as well as in their role as supervisors. And the starting point for that work is the view that the risk metrics that are currently out there guiding financial market participants do not sufficiently account for climate-related financial risks, including the risk metrics, for example, that underpin monetary policy decisions, that underpin the decision, for example, whether a central bank buys a certain asset or accepts a certain asset as collateral or not. Central banks today, basically worldwide, use rating agencies or the ratings they get from external rating agencies to determine whether assets meet the risk thresholds that they've set themselves. And at the same time, central banks are out there saying the ratings that we get from rating agencies do not sufficiently account for climate risks. And the logical conclusion is obviously, well, if that is the case, and if we want to ensure that our own risk standards are adhered to, we need to build in additional risk analytics to make sure that if we only want to buy, let's say, BBB corporate bonds, that what we buy is actually BBB and doesn't come with a big additional climate risk that is currently unaccounted for. Other central banks have started taking this a step forward towards more of a policy coherence approach. And here again, I would like to share a slide with you with two quotes. The first one from the governor of the French Central Bank, Mr. Villeroy de Gaillot, and the second one from the chairman of the governing board of the Swiss National Bank. Mr. Villeroy de Gaillot said recently, actually, let's face it, the ECB's balance sheet is exposed to climate risks through the securities it purchases and the assets pledged as collateral by banks to an extent that is insufficiently taken into account, and he proposes to start decarbonizing the ECB's balance sheet. This is the concrete step that is now on the agenda of several central banks under a risk narrative to align their instruments with a broader sustainability agenda. And in contrast to that, you had the Swiss National Bank last December effectively taking a decision that is not completely similar, but using a different argument, saying in Switzerland, there is a broad consensus to phase out coal. And this is why we as the central bank, in aligning ourselves with the broader objectives the country has, will exclude all companies that are primarily active in the mining of coal. And again, I'm sharing this as an illustration of how different narratives drive decision-making and how the alignment of instruments then looks like. Accounting for climate change considerations in the context of monetary policy is just one of many examples where such alignment is, I think, urgent. And if we have time later on, Sunil and Jay and Ann, I'd be delighted to explore this further with you. For example, to what extent other instruments in the monetary policy toolkit, such as targeted refinancing lines, could be better aligned with sustainability objectives. Some of you may have seen, for example, that there are suggestions out there for targeted refinancing lines that would fund energy efficiency renovations across Europe. There's certainly a big discussion to be had around the integration of climate risk considerations into financial supervision, both on the micro as well as the macroprudential policy side, and what that, for instance, would mean for capital requirements. And finally, moving to a completely different topic, there is, I think, a great need for central banks and financial supervisors to better understand the distributional consequences of what they do, the impact on inequality, and to think through how could the instruments they deploy be recalibrated to reduce the distributive impact that they currently have. But let me end here on instruments and move over to what I think is the third building block to align financial governance with sustainable prosperity. And these are the institutions. The organizational setup that we have that drives financial governance. And let me start off with an alignment or with an example of the types of alignments that are already happening now, linked to the previous discussion on climate change, which is the buildup of capacity within central banks in addressing climate crisis or climate risks. The Fed is a case in point, as you see on this slide. It has recently announced the establishment of a supervision climate committee with a senior member of the New York Fed moving over to the Federal Reserve Board, bringing together senior staff members from the board as well as the Federal Reserve banks. Similarly, the ECB recently announced the establishment of a climate change center. Notably, however, was the difference that the ECB center in its design is also meant to cover the impact of climate change on monetary policy, whereas my understanding is that at least so far, this new committee at the Fed is focused exclusively on the supervisory role of the Fed. And my hope would obviously be that this gets expanded to also put into scope the role of climate change within monetary policy. More generally, and in addition to building up capacity on new issues such as climate change and inequality, the alignment of the institutions governing finance with a broader sustainability agenda must also be anchored in the processes through which decisions are taken. And I know that Ann and Sunil have written extensively, for example, on the importance of busting silos and of bringing in a diversity of views to take decisions on matters that are as complex as the matters that that central banks face. So alongside with that, there's also a great need, I think, to expand capacities, beliefs, and assumptions that these institutions hold, as well as the mechanisms to ensure transparency and accountability. And while first steps in that direction to broadening expertise and perspectives have been taken, I would argue progress has been very slow. So if you look at educational, social, and professional backgrounds at central banks, they continue to converge on a very narrow range. Gender and racial diversity remains low. Alarmingly, the 19 national central banks in the Eurozone are exclusively presided by men. Only 2 out of 12 regional Federal Reserve banks in the US are run by non-white presidents. The other 10 never had a non-white president throughout the Fed's history. The advisory groups that central banks engage with to get information, to get different views, are largely confined to market participants. And the models that are being used in central banks still, I would argue, only reflect a very narrow range of schools of thought. And I think this must change. To meet the complexities that these institutions face, there must be a broader range of views. There must be a broader range of experiences being brought to the table. And now finally, let me end on the topic that usually comes up first when one enters a conversation around central banks, and that is their independence. And I've deliberately put this topic to the end because I think starting with it, doing what we very often hear, which is arguing that you cannot ask central banks to do X, Y, Z because that would endanger their independence, I think that just puts the logic upside down. Because in my view, we need to first understand and decide what the purpose is of an institution, what the powers and instruments are that we give to it in order to pursue that purpose, before we talk about the institutional setup and the degrees of independence that this requires. And at the same time, obviously, the discussion about independence is a crucial one and actually already on its way. Because, Sunil, I think you did mention already that the the powers of central banks and have extended significantly. Therefore, the repercussions they have on a broad array of societal issues has expanded. And that obviously brings the question whether the decision-making processes that have been put in place 30 years ago are still aligned with that broader toolbox. And I think we're in for a reassessment. And I would like to propose 5 aspects to guide this reassessment. First, central bank independence is not a binary concept, but a matter of degree. Financial authorities, like any public agency to which powers are delegated, require an adequate level of autonomy to deliver on their mandates, but at the same time, they never act in a vacuum, but are subject to narrower or wider guardrails that are to be defined. Second, reviewing the independence of central banks requires a clear distinction between their role with regard to monetary policy and their supervisory functions. And I think it's interesting that very often these two aspects get thrown together and we just talk about the independence of central bank, forgetting where that notion that central banks should be independent actually comes from. It comes from the view that in order to guarantee price stability, we need a credible commitment by the responsible agency that it will stay on a certain path to safeguard price stability, to keep inflation below a certain target, which is a very different area than what they do on their supervisory side. So we need to really keep separate the independence that is required in these two areas. Third, appropriate levels of discretion must be aligned with the instruments that are being deployed and the effects they have. So a central bank that does nothing else but moving a policy rate up or down has much less societal repercussions than a central bank that engages in setting policy rates, in asset purchases, in yield curve management, in targeted refinancing lines, in emergency credit lines, and the list goes on. And we need to keep in mind what the toolbox really looks like and what type of effects it has to have, I think, a comprehensive discussion around independence. Fourth, a review of independence must be granular. Degrees of discretion can vary across and within instruments. We might want to give full discretion to a central bank to decide about the size of its balance sheet, but that doesn't preclude Parliament from giving guardrails on what these assets on the balance sheet can be invested into. We might decide that central banks can act as lenders of last resort, but under certain circumstances require congressional approval or at least involvement. Or, as happened as a result of the last financial crisis, we might say, when in the case of the Fed, you can install emergency lines, but there needs to be an involvement of the Treasury in it. So there are very different degrees within instruments of independence, and I think we should make use of these different features and think through where we require which institution with what capabilities to take decisions. And finally, I would argue that independence must be understood broadly, and thus not only cover the level of autonomy a central bank has from a government, but also the ability to take decisions without undue influence from other actors. The extent to which central banks are dependent on market participants in transmitting monetary policy, the degree to which regulatory capture affects supervisory decisions, and the constraints on financial policy posed by one central bank on another. Take, for example, the impact that swap lines that the Fed offers or that the ECB offers have on the ability of other central banks who get such a swap line or who don't get such a swap line. That is significant. And I think we need to understand independence in that broad concept. So with that, the purpose, the instruments, and the institutions, let me just end on reiterating that I believe financial governance must be aligned with the broader objective of sustainability, prosperity. The concrete interpretation of that objective will vary from country to country. It will also vary across time, but I think it provides the compass that must guide financial authorities in their decisions. And I believe our current view on what financial governance is and what it should be falls far short of that. And my hope is that conversations such as the one we're having today can contribute to deepening our understanding of where we stand and give us an impetus to think through of where we want to go to, and most importantly, how we get there. And with that, I stop, and I really look forward to the conversation. Thank you.
Unless it already happened today. The Biden administration is going to release updates on what the social cost of carbon is, and that they are going to direct agencies to bring those notions of the social cost of carbon into regulations. And over the next 6 months, they're going to even set a wider trajectory for what's going to happen there. Well, if I'm the Federal Reserve, and I actually think the government is going to take seriously climate change and is going to put in place a social cost of carbon that could be, $60 today, but could be $120 5 years from now, then all of a sudden, it's not the damages from climate change unmitigated that I need to think about in the risk weighting and in the stress tests and things like that. Then I need to say, wait a minute, there are a whole lot of assets that are worthless if the social cost of carbon is $120, and either through regulation or through market prices, we put that into the economy. Then I need to, even before those regulations come into place, I, as the Fed or as the financial regulator, might say, look, you can't have, if you have a lot of loans to coal companies, I'm going to charge you a high risk weight. If you have a lot of, if you're funding pipelines that are going to be useless at a social cost of carbon of 100, then I need to recognize the payout on those pipelines may only be for a few years because they're just going to stop being used. And so in that sense, I think you can still use the risk approach and actually bring a lot of policy coherence into it by taking into account the fact that the policy approaches, if they happen, will have serious financial implications as well. The other thing I want to do is focus a little bit on the differences across central banks. And I think that it is important because I think in the paper and in the talk, Alex, and I think it makes sense when you're trying to give a broad notion, talks about central banks broadly, but I think because they have very different both operating rules and charters in some sense, it's useful to think about the differences. And so in particular, I want to talk about the Fed and the ECB, largely because they're the two I know best. And so I'm going to talk about them. But I think, Alex points out a number of places the Fed goes far beyond a narrow inflation mandate. But that makes total sense because the Fed doesn't have a narrow inflation mandate. So any case where the Fed has moved more broadly to think about employment or anything like that, it's not broadening its mandate. It's literally just following its mandate. I would, in fact, argue the framework review that the Fed engaged in, that I think in the paper is mentioned as, well, maybe this is the Fed taking inequality more seriously. I would argue, actually, it was just the Fed taking its mandate more seriously and recognizing that it consistently was falling under its inflation target and consistently falling below its maximum employment target. And so it needed to change the framework of monetary policy just to hit those goals, let alone any broader goal. And I think anything the Fed has done, whether it's, Greenspan in '87 walking out and saying, we will provide whatever liquidity is necessary so that this stock market crash doesn't take out the economy, through the actions in '08, the actions in 2020, I think all of them can be construed as just focusing on the Fed's mandate of price stability, maximum employment, with kind of a little adding on of financial stability, which is in its mandate broadly. It's mentioned in there. And so I think it has stuck largely to that. And I think in part because its mandate is more narrow than the one Alex mentioned that a number of other central banks have I'm looking up the specific language, but the support economic policies more broadly within the European Union and part of accomplishing the goals of the EU. I actually don't think the Fed has quite as broad a mandate. And so I think it's an interesting contrast to see in those two. And the Fed also uses a far more narrow set of tools that, let's just look at our kind of thing that motivated a lot of central bank research, I think comes from the fact that that primarily is the tool the Fed uses on the monetary policy side, as opposed to buying and selling loans and corporate bonds and being a lot more involved in the financial system loan market the way many other central banks are. I think the conversation about the ECB is the really fascinating one to me, because if you go back to the formation of the ECB, many people, myself included, back when I was a graduate student, were terrified that the overwhelming foundation of a simple price stability mandate was setting up a lot of really bad risks. And that by having price stability as the only thing, first of all, it was going to lead the ECB to at times ignore recessions and things like that. But in particular, there was nothing about a lender of last resort in the Maastricht Treaty. There's no prudential supervision role for the ECB initially. No employment part of the mandate. And so I think there was really a concern, boy, if things go badly, the ECB is just going to sit by and watch. And then I think Alex is correct. That is not how they've operated, right? They have consistently through time taken actions, whether it's dealing with banks or sovereigns in the Euro crisis or other things where it looks a lot more like the ECB is not simply an inflation targeter. I think you could go to Mario Draghi's speech of, we will do whatever it takes to save the euro, right? It was not, we'll do whatever it takes in the context of our price stability target, right? It was, we will do whatever it takes to save the euro. And so I think we've seen the ECB willing to go broader. And then I think it is very fair to ask the question why it's not going even more broadly when the charter says, as one of the quotes Alex put up noted, it's not an option to pursue these other goals. It's part of the mandate to support these other goals. And so I think that is a really fair point. And I think some of the examples he gave around what's held in the portfolio, I really like the one about the Riksbank saying, we're not going to hold bonds from Alberta because they do too much fossil fuel. Things like that, I think, really demonstrates where central banks have very clear tools, very clear options, especially when it's in their mandate. I would say on that, the Fed doesn't hold bonds in the same type of way. It basically holds treasury bills under normal times. And so it may not have exactly the same leeway as the European Central Bank there. Again, on the risk side and on the supervision side, I think it has incredible leeway in its tools. The monetary policy side may be a little harder. I think the bigger question, and one that maybe we'll talk about more as a group here, is the extent to which central banks can lead versus follow here. On the one hand, again, with legal authority questions, do they have the legal authority? I think Alex is right, certainly, that the ones with that broader mandate, it seems they do. I think the Fed, it's a little bit more murky, except on the financial supervision side. But even if they had a broader mandate, I think the Fed in 2020 is kind of an interesting example. If it had the exact same clause that the European Central Bank had, would that have given the Fed legal authority to do anything different in 2020? Because the reality is the US government at the time had a declared stance that climate change was not a problem. The social cost of carbon was about $5 a ton, and no regulation should be put in place that dealt with the climate. So if that's the stance of the government, does the central bank have authority to do anything, right? Because if it's supposed to be supporting the goals of what the government is doing with economic policy, it becomes less clear that it has the authority to do things that aren't the government's goals. Now, certainly, as of today, where you've got a new administration that has declared climate change a huge risk and is trying to put in place a whole of government approach, and it's explicitly something you hear the president say a lot, we need a whole of government approach to climate change, right? I think that very much leans into Alex's point that, well, the Fed is there, the financial regulators are there, they're part of government. The president is saying we need a whole of government approach that points to using this broader approach. I want to just quickly flag inequality because I focus more on climate change and I don't want to run too much over time here. I will say on inequality, I think broadly, that is a place where the most that a central bank can do often is to focus, or the most important thing a central bank can do generally is to focus on the maximum employment part of their mandate. That if you look across the world, but especially I know this best in the US case, the most marginalized workers are always the ones who are hurt most by recessions and helped most by booms. And so by pursuing a goal of maximum employment, the central bank is doing a lot to help out on the inequality front. I think Alex is right to point out there might be some things on the wealth inequality front that show up differently there. But that's the place where I would at least argue, in that case, the thing that the central bank can do to combat wealth inequality is cause recessions, because recessions tend to reduce wealth inequality because they hurt asset holders the most. And I don't think that's the kind of thing we would suggest the central bank should be pursuing. I think there may be new tools you could come up with that would allow it to pursue maximum employment in a way that helps out people at the bottom even more. But I think most of those, and I think the paper even suggests this, most of those come through fiscal monetary cooperation that I don't think the central bank can do on its own. I think it would need to be coming in kind of as part of the tools brought in from the government side and from the fiscal side. The last thing I do want to just flag is a question of kind of first best. And I think it is important for us to remember, just because the central bank can do some of these things and can help at the margin, it doesn't mean it's where we should put all of our emphasis or kind of all our eggs in that basket. And I just want to emphasize that, because we sometimes see, well, look, you know, central banks are effective at fighting recession, so let's forget about fiscal policy as a recession fighting tool. It was a terrible decision to think through, right? And so similarly, my only concern is if we start saying, hey, central banks can do this, that it puts us less in a place of advocating for the more effective tools. And the example I might give there is, you know, I think we could come up with some ways that central banks could help on inequality more than they currently do. On the other hand, in the big relief package the Biden administration proposed, the child tax credit that they proposed would reduce child poverty in the United States in half. That's a big deal. That's the first best tool. That's the way to go at inequality. Similarly, you know, if I think about climate, the investment tax credit and production tax credits that funded wind and solar energy and helped them get off the ground in the United States were massively important to bringing down the cost of renewables, to the point now that coal is going away, not because of regulation, but because of the cost of renewables. You know, that's hugely consequential. Changing the bond portfolios of the central bank that might change 20 basis points here or 10 basis points there of the cost of a pool of bonds, I think is important. And under a whole of government approach, you should do. But it's not the same power of lever. I do think some of the things Alex mentioned, that especially central banks with broader mandates might have the ability to do things like finance at negative rates clean energy, right? Like now all of a sudden, you're not talking about 10 or 20 basis points, you're talking about serious moving the needle kind of thing. But in some ways, that's very similar to fiscal policy funding renewable energy. And so I think it depends on the structure of the central bank, whether it has the authority to do it. And it, again, almost feels more like fiscal monetary cooperation. And I just want to emphasize it's a place where we don't want to let everyone else off the hook for the things they should be doing, because those levers are often far, far more powerful. So I think what I would just conclude saying is I agree with Alex. I think there's a lot central banks can do, and in particular, a lot financial regulators can do to move the dial on climate, and they should be doing. And I think the interesting questions all become in the subtleties across central banks, the subtleties across how the stance of governments that those central banks are dealing with in terms of what they can really do. With, again, just remembering that, you know, the big thing we need to do is either regulate or put a price on carbon or things like that that would, you know, move the needle on these things in really more substantial ways. So I'll stop there. Sorry, I'm 1 minute over. Turn it back over to Sunil.
Thanks very much for your comments, Jay. Let me try and, in some sense, frame the discussion, and then I'll come back with a few questions, and we have some in the Q&A. One way to try and conceptualize what we are hearing in terms of the discussion on the roles of the central bank, when we think in terms of a risk framework, a lot of times that in some sense entails that the central bank is a passive participant and taking care of climate change or inequality or whatever as a passive player. I think what I hear both of you saying is that when we think in terms of policy coherence, it is not just risk that we need to be concerned about, but what policy coherence means that you want to have a central bank which is more active in particular ways, coordinating with the other agencies to deal with problems which are societal objectives, but may not be in its primary mandate. That, and as both of you point out, rightly implies is going to be different in different countries. It's going to depend upon the political environment. It's going to depend upon how this has been historically pursued. So I think it's right that different central banks will prioritize in different ways. It's going to depend upon the politics. So let me start by a very simple question that it came up in the Q&A and comes up in other times is this whole issue of one objective, one instrument or one tool that you need. So this whole Tinbergen rule can be, I think that central banks in many ways have many other instruments that they can use. So how do you respond? So how do you respond to that, Alex?
Thanks, Sunil. That's a counter that we hear often. For those of you who are not familiar, the Tinbergen rule essentially says, if you only have one instrument, you can only have one goal. And I just think that is mixing up instruments with policy fields. Monetary policy is not an instrument, it's a field which has a huge toolbox at its disposal. And as Jay said, that includes forward guidance, asset purchases, policy rates. So I think the Tinbergen rule doesn't apply here. And on top, as I said earlier, we're already in a world where central banks deal with trade-offs, and I think they have to. And it's just unrealistic to think they just have that one goal and everything else can be ignored.
I would just add to that I agree with what Alex just said there, but also the point about trade-offs to me is the most important one there, in the sense that even if they only did have one tool, which I don't think they do, I think they've got a whole range of tools and they've demonstrated their increasing creativity in finding different tools. But even in a world with one tool, the entire point of that reaction function I described at the start was that they were balancing off inflation and unemployment, right? Like the idea that it is true, you can't single-mindedly go after one goal without having implications for the other. But that doesn't mean you can't try to strike a balance between the two goals. So I think that rule, as an international macroeconomist, I totally believe you can't run purely independent monetary policy and fix your exchange rate, right? You've only got the interest rate to kind of do both. You can't do it all. But you can certainly kind of make compromises in between the two. And in the same way, you can think about inflation and unemployment and think about any kind of trade-offs. So I would just say, I think the idea that they don't have the instruments and that they only have one tool means they can only have one target, I just don't think is accurate. And I also think they just clearly have more than one tool.
The question on, when you discuss mandates and the functioning of central banks, this whole question of independence keeps coming back. And there are a couple of questions here. One is that why have central banks in some sense adopted this very narrow narrative on what they should do and can do? Whereas in practice, we see them doing a lot more. In fact, you could make the argument that the central bank is a central organization in a sense that has a macro perspective on the economy. So I presume that the political economy can be difficult to traverse here. So how does one then talk about a central bank independence, that we really want them to be independent to a degree in certain areas, but in other areas we really want them to speak truth to power? Because in a sense, if you think about the reaction to the 2008 crisis, we have overextended monetary policy. In many countries, because of political dysfunction, fiscal policy was not available, or not available to the extent that was probably needed. And yet central banks, critics would argue, were passive in some sense, accepting the responsibility of being the only game in town, when they should have pushed back much harder to say, we've done as much as we can, and now there are other tools that the government needs to use to react to this crisis. Do you have any view on that?
I guess
Alex,
yeah, I mean, I guess I would say on one aspect of that of their independence and what it means when they especially are facing a broader and broader mandate. I think there has broadly been an argument that if the goal is price stability, and even I think arguably price stability blended with full employment, right? The dual mandate type setup that the Fed has, that realistically you are going to do better if you let the central bank pursue those goals in a more independent fashion. And I think that is true. I think what we've seen is if you broaden their mandate in many ways past that, sometimes it does become more political and actually maybe they don't need as much independence there. And I think the example I've seen people talk about is within the Bank of England, for example, where the Monetary Policy Committee is still supposed to be far more independent, but that there is a financial stability oriented committee that has more political actors involved. And I've seen people like Stan Fisher, who was, both vice chair at the Fed, but also ran the Bank of Israel, just talking about when they were faced with questions in Israel of, changing loan to value ratios and things like that he did not feel, he felt it in fact was appropriate that there was a broader political conversation there, because it's not as simple a tool. And it's, well, this has impacts on, young home buyers versus older home sellers and there are all sorts of political trade-offs that come in, that he was like, yeah, the central bank doesn't need single-minded independence over a goal like that. It's a political goal. You should broaden it. On the pure question of, setting monetary policy to deal with inflation and employment questions, I think that's where I at least am probably still more comfortable saying appoint smart people, give them good targets, and tell them to go hit their targets.
I can just
Alex?
add, Sunil, I think Jay just mentioned an interesting aspect when mentioning targets, because overall, I think we need to be much more granular in that conversation. And I'm picking out the targets because there you have a difference in degrees of independence, because some central banks have goal independence, setting their own targets, and some central banks only have instrumental independence, getting the target to be set by government. And the setting of targets, I mean, we didn't have enough time to get into this, but the setting of targets is such an important decision, right? Which measure of inflation do you use? Just for example, do you take the cost of rent in your inflation measure or not? What's the time horizon across which you target inflation? How do you deal with going over or above? These are crucial societal decisions. And when a central bank has goal independence, it goes ahead and takes that decision itself, whereas other countries that have chosen to say, no, we'll give you that target, and then you'll be responsible for implementing it. So that's just one aspect of the granularity that I think we need in the conversation.
I would just add to that I think it also depends in some sense on what you could almost call the temporal independence of the central bank, how much you need to get into the granularity for them. And what I mean by that is the Fed is operationally highly independent until tomorrow, right? The Congress can rewrite the Federal Reserve Act tomorrow. And the Fed knows this. In fact, there's a famous story about once during testimony when the Federal Reserve Chair was being a little too cheeky in terms of his answers, he was passed a note from the podium that said, please recall the Federal Reserve was created by an act of Congress, ... And the ... was not particularly subtle. It could be uncreated in a moment's notice. And in fact, there are many people who think the fact that Dodd-Frank was open and being debated constrained the way the Fed responded in the Great Recession, because it was a little worried that, well, gee, maybe they're going to put a whole bunch of stuff in here that constrains us. And so we better not make Congress too mad. You contrast that with, say, the European Central Bank, who, if you want to change the European Central Bank, it's hard, right? Like you need to get a whole bunch of countries to agree to this. And so the idea that if the central bank is just immutable, you need to give it far more detailed and granular things. The Fed, Jay Powell was being asked yesterday, what do you mean by full employment, right? Is 4.3%, would you go below 4.3%? He can get pushed on that in Congress, and a Congress who doesn't like his answer could rewrite his independence tomorrow. That's different for the European Central Bank. And so I would say for central banks that are more independent in a temporal sense and can't be rewritten, writing in far more granular ideas in some ways, or at least the ability to change their view of what the goals and targets are is probably even more important.
So let me ask another question that both of you spent some time discussing, and that is not just looking at central banks, but if you think of societal response to an emerging climate crisis. Now, this is clearly of systemic nature, and we are faced with night in uncertainty, we are faced with nonlinearities, we are faced with tipping points. We don't completely fully understand how it may play out. What would be a best way for central banks, and given that you've talked about policy coherence, other agencies, to mount a societal response to this emerging crisis? What role should central banks play? What should be what can be the prioritization? And let me go a little deeper to say, why am I asking that question? If you think of the objectives of the central bank, these are purely instrumental objectives. We don't like price stability and financial stability per se. We want them because they help us attain some societal goals. Society is now facing an existential challenge. Do we need fundamental institutional reform? Do we need fundamentally different ways in which central banks should interact with other agencies? Do we need, in some sense, I think that we need to fundamentally also look at the way political decision-making is taking place. Because ultimately, that's where the representatives of the citizens reside. If there's political dysfunction, we can do whatever we want here in terms of organization. It's going to be very hard to mount a societal response to some would say fast-moving challenge. Some are saying this is a slow-moving challenge. So do you have any thoughts on what roles can financial governance play in trying to orchestrate this to response to climate change?
I mean, first of all, Sunil, I'm happy that you highlighted that these goals of price and financial stability are instrumental, because it, I think, just shows how upside down we have the narrative very often. Because we would say climate change is an issue for financial authorities because it affects financial stability. And as you said, well, actually, we're after financial stability because it's a prerequisite for societies to thrive, right? And not vice versa. So I think that's a good starting point for the conversation. I don't have a full-fledged plan, but I think indeed we need to move beyond the risk narrative that is currently kind of the foundation for central banks to act. I'm happy that they're acting based on that narrative. I think it's an important first step also to build capacity, but I'm also conscious that as they build capacity, we need to move beyond the question, well, how do we reflect risks in order to address climate change? And just to give you one example, which also allows me to tie into Jay's earlier remarks, for example, think about funding the transition through a much closer cooperation, and Jay, you mentioned that, between fiscal and monetary policy. And in fact, I happen to believe that the institutional setup in the US actually offers, and you guys all know that much better than I do, but offers a really interesting feature, because you have these emergency lines in which Treasury plays a role, which adds legitimacy to these emergency lines, right? So you can have a cabinet, an administration say, we believe this is an emergency, we will provide funding through Treasury equity into an emergency line, and we leverage that funding through the Fed in order to fund, let's say, a energy efficiency renovation program across the United States, which will create jobs, which will reduce costs for poor people because energy efficiency is going up, and which will reduce the greenhouse gas emissions. Just as a parenthesis, that is something that is currently also being proposed towards the ECB, but I think the Fed has, or the US has, this advantage of an established institutional interplay for emergency refinancing lines. And I think taking a closer look at that would be a really good first step.
I would just add on that one. I think that's exactly right. And I also think, though, it highlights this question of what do we want the central bank to do versus how do we want to use the central bank, right? And so to Alex's point there, like the lines that were set up were not set up with climate goals, right? Like the Fed was not told to do it. And because it had to act in conjunction with the Treasury, even if the Fed had wanted to, Secretary Mnuchin probably could have blocked it. And so I think there is, in that sense, we have to recognize where can we use the central bank versus what do we just want it to do on its own. I will argue still that I think even within that risk framework, there's a lot they can do. And they can go much, much farther, in particular, not just thinking about the damages from climate change, but thinking about how an appropriate policy approach to climate change would change the economics in the future and how that would really change assets. And so I think even without trying to give the central bank new mandates and new anything, they can do more. And I think on the optimistic side, I think they're aiming towards doing more. I think they are looking at how they need to do this and how they can get involved. Maybe not as fast as everyone would want, but I think they're taking steps. I think the harder question becomes, especially for the central banks that have this broader mandate of, support the overarching policy goals. What do we want them to do just on their own? Where do we want them to just make these decisions that, hey, the goal is climate. All right, we're going to start spitballing here and making stuff up. I think at the very least, some of the things Alex pointed out where, look, they own certain asset classes, they back certain types of loans. That stuff seems easy, right? Like, so don't make things worse with your loan portfolio, right? Like, don't fund dirty stuff. Like, I think there are places we can see the central banks and financial regulators move in a very positive direction. I think the harder part then becomes the politics on any place where you want them to coordinate with political agents, because then you need the political agents to be able to do it and to pass the laws and to make the choices.
Let me just weigh in here for a second, and we've only got a minute or two left. Alex talked earlier about the need for a much wider diversity of voices. You're both talking about the need for different kind of capacities within the central banks. There was a question that started off in the Q&A about to what degree are people in the central banks using this narrowing of the mandate as essentially a way of avoiding things that they don't know how to handle. How much of the problem is an external one about politics and mandates and the rest of it? And how much is an internal one of the mindsets and the lack of capacities to have judgments to do the kinds of things that Jay was just talking about?
And I can only hypothesize. My impression is that it's an issue not internal to central banks, but internal to the economic profession. So that we have a dominating narrative within the economic profession that this is what central banks should do. And therefore, when they deviate, it's not just people within central banks, but also observers, commentators, even members of parliament that would go, this is not part of what you should do, right? And then on top of that, I think the world of central banking is a very tightly knit club internationally, where we've seen this over the last few years. You see a central bank taking a step and the others following. Nobody is going all the way out there. So I think there's a tendency of taking small steps. And coming back to your question, Sunil, I think it's too slow. And we need, in this whole conversation, move from a conversation around direction, which more or less points in the right place in many cases, towards a conversation around speed. I mean, I shared with you this proposal by the governor of the Banque de France, which I think is absolutely the right direction, but he said, let's do this. And he said, this is ambitious in 3 to 5 years. And I don't see why we need 3 to 5 years to get climate risk management integrated into what central banks do.
I agree with all that. I'll take the slightly optimistic stance on a personnel question. From my office at GW, I can see the largest collection of professional economists in the world, which is the Federal Reserve Board. They hire more than anyone else. They employ more than anyone else. If they choose to take action in a direction, they can scale up fast. And there are tons of smart people there who care about this stuff already. So I think in that sense, the idea that they could take substantial and swift action, I don't think personnel is the binding constraint. I would agree with Alex in some sense, it's ambition. That's the binding constraint. And on that front, I guess what I would say is they are operating slowly relative to the crisis, but quickly relative to what you would have guessed a decade ago. And I think when Mark Carney was first starting to talk about climate in central bank spaces, there were a lot of people, and that was like in 2015, and there were a lot of people looking around like, what is he doing? Like, that's not a central bank thing. And whereas now you've got, as Alex mentioned, you've got groups of central banks from around the world where everyone basically is in saying, hey, we got to figure out this climate thing. Are they doing it as fast as we'd want? No, but on that front, I almost give the central banks some credit, right? Like the US just rejoined the Paris Climate Accords like a month ago, right? Like it's not like the central banks are behind everyone else in climate, right? They're not working as fast as we'd like, but no one's working as fast as we'd like on climate. And so in that sense, I am not uniquely pessimistic about the ability of central banks and financial regulators. In some sense, I'm more optimistic about them once they've decided to go in a direction they can actually get there better than many can.
One final comment before I turn it back to Sunil to close us off. This question of pace and scale ties really nicely back to the previous webinar in this series that we did on January 27th with Sir David Hendry, who was taking us through essentially all of climate science and where we actually stand. And this question of how fast climate change is moving is actually even scarier than the total scope of it. It is the fact that we are undoing what nature has done over many millennia in a decade or so is what is absolutely terrifying. Central banks don't have time to mosey along on this. If change doesn't happen rapidly, it may not happen at all.
Okay, I think we've come to the end of the seminar, and what I want to end by saying is that we discussed climate risks, we discussed inequality and sort of social issues. There is the politics of all this. And the reason why we are having these discussions is because I think that the combination of the only way I can frame is that political challenges combined with challenges of rapid climate change, combined with the fact that we are in a state of economies where there's rising inequality both in terms of income and wealth, that these three are interacting in ways in which things are going to become very messy going forward, and that we have to have these conversations because it's going to involve a whole of economy approach, whether we like it or not. How we react to it may be different in different countries, but I think that the combination of all this is going to keep throwing up some very wicked problems that we should be thinking about and preparing plans for, because when things happen rapidly, we want to have at least something around that we can respond with. So I think with that, let's end the conversation. I thank everyone who participated, Alex, Jay, Anne, for a scintillating conversation, and thanks everyone for joining in and asking questions. Thank you very much. I sort of bid you good morning, good evening, good night around the world.
Thank you.